Well, hello and welcome back to Master Horn Investing. This is Brian Horn. Thanks for joining me today. Today we're going to be talking about some of the overall market conditions as well as an update on some of the stocks we're looking at. A little bit of background on me in case you haven't seen that before. I just remind you that YouTube requires 1,000 subscribers, so for their algorithms and advertising, all kind of stuff. So help us little guys out and hit that subscribe button for me. Appreciate it. So we want to look first of all at the markets. So let's start with the Dow. The Dow Jones Industrial Average. So this is how it's been trading here over the last year. You'll notice that it came up and right here hit this moving average. That's this blue line that's kind of following along here. Then it came down, hit the moving average again. This time back in November, late November, it punched through, came up and then hit a downward trend line. You can see up here at the top. Hit it several times here, and then it's come back down and now it's broken this trend line again. And you'll also look at the RSI is all very negative, like right here. This does not bode well for the Dow. Okay, let's look at the look a little bit closer, a close-up view. So here we got this blue line here that's kind of trending along. That's the moving average. Then we have the we have a couple of the downtrending lines because we have a a wedge kind of going on here. And you see that the markets broke both of these, came down through it right here, and then came down again and punched right through and went lower. So the Dow is significantly below. So the Dow looks like it's in trouble, not doing well. So we expect the Dow to continue down. How about the S&P 500? Same problem. Let's look at this one here. This gives us a little better idea. So now if we look at the overall market, I want you to notice a couple of things. You got these kind of highs going on here and then a higher high. So the market was coming down, hit a low, came back up, came down, and then went to a higher high. Then it came down to a lower low. Then it came back up, came down, went to a higher high, came back down. It's done this 3 times now. So very highly expecting this to go down again to a lower low. So this is kind of a little bigger picture that kind of shows more of this. You see the markets are trending up, came down. Here's the lower high, here's the higher high, and then it came down to a new low. Then we had a lower high, a higher high, new low. Lower high, higher high. We would expect now a new low coming down here. You see this big volume on these down days. It's looking pretty scary. We do have some supports right here where these markets going over before. So normally the market would come down, bounce up a little bit, come down, maybe hold, maybe bounce up before it goes down again. It doesn't have to. That's generally what happens when they have these support levels. Okay, so here's another look at the S&P 500. You got this downward trending line going like this, hitting where these highs are. As you see, it kept hitting this market here and the 200-day moving average, both which were trending. We got right up to them and then boom, sell off. Okay, so the markets, this does not bode well for the markets. We're expecting a down market. The market will probably sell off over the next year. Now there's going to be some bounces in there. Yes, there'll be some kind of bottoms that kind of runs back up and then goes back down to lower lows. But we don't expect a good market until about next March. Now let's look at 2007 and we're going to compare it with 2022. This was when the markets were trending down. And then right here on that black line you can see is where the day Lehman Brothers announced their collapse. And then the banks came out, then the government said, we're going to bail out, we're going to bail them out. We're going to support this thing. It's too big to fail. And you had this couple-day bounce back up, right back up to the moving average. And then it came down, hung around, and wham, we started a huge sell-off. Markets were down, as you remember, back in 2007, 2008. Markets went down 50% before it was all done. Something similar could easily happen between the 2021 and 2022, a total of about a 50% decline between the 2 years. Now let's look at 2022. We have the same pattern. Markets were coming down like this and had this big sell-off on Wednesday, Thursday, Friday, right here. And then over the weekend, which is right here, this was the bank fail. So the banks were failing during this time. The government came in and announced that they were going to, bail the banks out, and everybody's not bail the banks out, but bail everybody, all the depositors out and so forth, and buy the bonds back from the banks and so forth. And so we had these 2 days rally up, and then it's come back down again. We're heading back down south. I mean, it's the same patterns. Okay, now we want to look for confirmation in the bonds. Nothing we know for certain, because all we can work on is probabilities. So what we're trying to do is look at the charts and look at the fundamentals and say, what are the probabilities? And we have maybe like an 80% probability the markets are going to decline big time, like another 20, 30% from here over the next year. Maybe there's a 10% chance of it trading sideways, kind of in a choppy mood, up, down, run back up, run back down, come down some more, come back up. Okay, so, or there's maybe a 10% chance of, the Fed saving the day, the Fed pivoting, banks all get their act together, supply chain issues resolve themselves, food shortages resolve themselves, the war in the Ukraine goes away. We have a chance of that, and the market's, going higher. That's maybe what, a 10% chance at best. So we're looking at probabilities. So now we're looking for and the probability is down. So, but we're looking for confirmation from the bonds, because bonds tend to lead the way. So here we've had this channel. You can see this kind of channel going up this way that the bond market's been kind of traveling in, going like this. It broke through. Again, this would be like, so interest rates are indicating, again, a hard landing, a problems in the markets. And so we're seeing that. So yes, the interest rates have been coming down. That's going to help people want to refinance who had to buy houses over the last year, and maybe get a refinance maybe at 4.5% or 5% that bought in at 6 or 6.5. But for the rest of us, the market's forecasting we're going to have a problem, so our interest rates are diving. So bonds are confirming what's going on in the stock market. Ackman says more banks are likely to fail despite the Fed's intervention. Well, yeah, I mean, you got as you're saying, these problems are not over yet. So let's look at gold. Gold loves these kind of issues because they love it inflation when interest rates are going back down. And we're going to take a look back to the 70s. So we had, for a couple of years, gold went up. Then we had about a year and a half of gold trended downwards. And then it went on this tear and went from like what? Yeah, it started down here at $30 or something. Got right here is like at 100, and then shot up to like 900. So it ran up like 8 times, 800%. Now let's look at gold from this year, these last couple of years. Okay, so we were trending upward just like we were back in the 70s. We trended higher. Then we've gone through this bull flag. A bull flag means a flag that goes in the opposite direction of the trend. So we have the trend going up. Here we have the flag that's coming down, and it's trading within this flag area here like this. What happens is it breaks out to the upside. So this is called a bull flag because markets go up, they kind of trend downward, then boom, hit higher again. That's where we're just in the spot of getting ready to break out. Now there is some resistance up here, like we've had a market top right here, we've had a market top right here. So gold, if it probably runs up, would probably hit this, come back down, which is get up here like what 2100 or something like that, come back down before it breaks higher. But gold's probably going to be one of the top assets. Gold and silver might be most likely one of the top assets to hold this year. It should outperform the markets, should outperform bonds. It's probably going to be one of the top markets. So the gold's looking good. Silver, the same thing, a little bit different. It's not really a wedge as much. I mean, it is, but it's not the same kind of a flag. But if you looked at a flag kind of going like this, you have a flag going. Same thing. We're going to be breaking out to the upside. Boom. And again, it should hit some resistance up in this range, up around 26, 28, 30. Well, 26 is right here. So let's say 28 to 30 range. There'd be some resistance where we had these tops coming in before. But silver's looking very good. So again, here's the kind of the wedge pattern more close up. When the banks started announcing all their problems, boy, silver bottom and then just skyrocketed higher. Now let's look at oil. Oil for the long term is looking very good. Here we have huge support at around $65 a barrel. So that's probably where we're going to go, maybe around $63 a barrel. So this number here that's 63. So we had this, we've been trading sideways again, kind of in a little bit of a cross flag. Broke down, as you can see right here. Chances are good it's going to come down into this range, and that's looking like an awesome buying opportunity. So we're looking very low on oil. Oil's looking good, and oil stocks are looking good. Still a good time to buy. If you bought some of that, what am I thinking here? Phillips 66, for example, and it's come down a little bit. I bought mine some at 99, some at like 101. Got most of it around 99. It's come down. I have a buy order and to buy some more at 90. May not get there, so I might just have to buy some here at 94 or something, 96. But Phillips 66 looks good. So this is oil again from just a little bit better chart. You can see this support line coming right across these numbers, support, and then it broke through, and then it became a resistance, major resistance line right there. So this is looking like a very good spot to be buying oil. So no one ever knows, could dip down a little bit lower, before it comes back up, but we're getting in a very good buying range. Good time to be accumulating these oil stocks. So now we're going to look, that's not Caterpillar. What's that one? We're still on oil, aren't we? Crude oil, dang it. Okay, well, I was going to look at Caterpillar. We'll come back to that later. So back in December, I had a sell recommendation on Caterpillar. Caterpillar had gone from like 150 and just skyrocketed up to like 235. So I was saying it was time to sell Caterpillar. It did actually creep a little higher during those runs back in January. I got up to like 150, which was a little annoying, but you can't ever sell right at the top. And then my suggestion was just get out of it. But if you wanted to and profit from the downside, you could buy a put. That would be, I said, the June 16th 230 put. You could buy that one. Well, Caterpillar's down, it's taken a big dive. It's come down below. It's down in the 210 range. Still looks like it'll go lower. So sorry about the chart here. Thought I had the other chart. Oh, well. Now let's look at Nvidia. Nvidia is actually pretty strong because of AI. There's a lot of AI companies getting in the space, and they need faster chips, and Nvidia is supplying a lot of those chips. So it's been kind of like having this run up here. But technology overall is just struggling. Chips overall struggling. And so right here, I had recommended selling Nvidia. And again, if you wanted to buy an Nvidia put, you could buy like a June or a May or something, like a 150 put. I don't think it's necessarily going to go down to 150 because we got major support up here like 180. But if the drops, you still get a rise in your put. So so you can kind of look at Nvidia there. I don't think you want to hold it through a market that's like tanking. Again, it's had a run. Still a good time to sell. So you still hold Nvidia. You could get up to this upper side of the 260, but we're going to be topping out. And I just don't like it for a long-term hold. Better off being out, looking to see if you can buy it cheaper if you really want it, or maybe even shorting it right now, or buying a put. So here's again how we're kind of looking on just on like a candlestick chart. See, here's 150, here's 146, 150 range. You see there's great support right there. There is a very good chance with the market selling off, it still could come back down here. That's kind of what I'm counting on. Okay, now Tesla. So back here at Tesla, so you can see this trend line right here that I have that's in gray, right above my red line there. You can see it was a major support for the markets. Boom, boom. Even like right here, it's just almost made it to it. This was a major support. Then when it broke through, then it comes up and becomes resistance. And so right here is where I said to put the sell order in on Tesla if you own Tesla. There's a lot of people that didn't like me saying that because they're Tesla lovers. I like Tesla too as a company, but the stock just looks sick. You can see you got this trend line going down like this. We got this flag coming down. Very good chance it's going to come down into this area, which again is where 100 was. And if it follows the trend where you actually hit the more like this, it could come down into this range, which would be more like at 80 bucks a share. So in a sell off with the market selling off, Tesla does not look good. And as you remember, I have a whole presentation on Tesla. You go back and watch it. But there's Jim Rickards, who makes bubble scores, ranges from 1 to 100, 1 being the lowest score possible, 100 being the highest score possible. So 1 means you're most likely to go down, way overvalued, lots of problems going on as far as the stock goes, about it making new highs or something. Tesla was a 1. It's got the lowest ranking that you can get on the bubble score. It does not bode well. Market going down, sales softening, people being laid off in the tech industry. So again, I suggested selling Tesla back here. Not a good time to buy it. And I suggested buying a put. And so I've got a 150 put on there. And I'm kind of looking for the things to kind of continue to climb. Hoping that can make some good money. It's a June 16th, 150 put. So again, we're looking at BOIL. BOIL, B-O-I-L, is a natural gas stock, EFT. So it's an exchange traded fund. Exchange traded fund, ETF. Okay, I gotta get my acronyms wrong here. ETF. And you can see this huge capitulation volume we've been talking about here. And my recommendation initially was to buy below 6. So a number of people got in like 585, a little bit more, maybe around 606, and ran up to like 780. Came back down as it got down below 4 again today. And 4 again, go into the 4s, got down below 5 today. Excellent time to be buying in on this. Same thing. This is kind of like oil. It's going to be kind of bottoming out soon, and so you want to be accumulating in these levels. So again, buying if you can buy down in this range, boy, it looks really good. Because look where all the support is at $22.95. So basically $23 a share. Huge support. Boom, boom, boom. If you go back farther, you can see it back here too. Huge support at this $23 level. So when it runs, it's going to want to run up to at least 23 before it stalls and maybe tries to break through again. And there's still a very good chance of it going a lot higher, like back up to 30, 50, somewhere in there. But certainly going from 5 to 20, you got a 4-bagger. So that still looks like a good time to be buying that thing. If you remember back in December, I said let's buy EPV. EPV goes opposite of the market. So when Europe goes down, the stocks go down in Europe. The fund then goes up. And you see back in here is where this is back when I was suggesting to buy it, back when we were over here. So initially it took a run up, so we were looking pretty good. Then it came back down, and it's just starting to run up again. So if you've been holding on this whole time, you're still just kind of like a break even. So it's still a good time to buy. Europe's going to, if the U.S. sneezes, you remember the rest of the world catches a cold, Europe's going to be heading lower. They have lots of problems going on over there, worse than the U.S., bank problems as well. And this thing's going to go higher. You can see, again, I mean, you got a gap right here that hasn't filled yet up here at the 15 level. So if you're buying in down at these lower levels, we're clearly going to be filling this gap. And then as things get worse, could easily be testing these highs again. And if the markets go lower in the U.S., they're going to go lower in Europe, which means it's going to well break through these and head higher. So in summary, if you have a 401k, you want your money in the money market or fixed account or the guaranteed account or the account that doesn't fluctuate for the most part. If you just want to be safe. If you want to try and make a little bit of money, you don't want to be in the stock funds, the aggressive growth funds, the balance funds, the growth and income funds, or any of the target funds. You want to be allocated maybe at the most, if you have a commodities fund. I've seen a number of 401ks that have commodity funds in there. Mine does. You maybe want to put up to 25% could be allocated in a commodities fund. Bonds will look good if the economy gets worse. Bonds are going to go up in value as interest rates come down. So even if the Fed is raising rates to try to choke off inflation, longer term bonds will be coming back down as they anticipate a slowdown in the economy. So you could put up to 25% into a bond fund. It doesn't have to be a short-term bond fund. It could be an intermediate bond fund or a government bond fund. That's an option. Remember, no stock funds, no balance funds, no value funds, no growth and income funds, no international funds, none of that kind of stuff. I did a video in January. It's called In the Eye of the Storm, where the analogy was we're in a storm, like a hurricane that goes over us last year. And then the eye of the storm comes over us and we all think everything's just fine. And it's like, hey, everything's back to normal. There's no wind. Everything's great. And the markets go higher. That's what happened in January, just like I said it would. And then the backside of the storm comes over and you realize that, man, there's still problems. There's still hurricanes. There's still winds. You still got tornadoes that kind of come off. There's storm surges. Lots of problems that can happen. Okay, we're still in that. We got the back of the storm coming over us now. And again, we probably won't be out of this thing for another year. So anyway, so you look for the photo of a hurricane on my channel, and you can watch that one if you want to get a little more idea. So stocks to kind of avoid: Nvidia, Tesla, CAT, FedEx. And pretty much anything that's just like market kind of sensitive. Stocks that look like you're buying, but again, things like oil, like Phillips 66, BOIL. The Europe that goes opposite the markets. I also like SPXU. SQQQ, so I'm thinking SQ, sorry, I'm can't write right here, I'm trying to write with my mouse. SQQQ goes opposite the market too. So as the NASDAQ goes down, this goes up triple. So it goes up 3 times whatever the market goes down. So if the market goes down 10%, this will go up 30. You can also get an SDOW, that's supposed to be an S, sorry, DOW. It does the same thing. It goes opposite like the market. So if the Dow goes down 10%, this is going to go up 20 to 30%. That's kind of the idea. So you can get an opposite market, which is the same kind of thing that this EPV is doing. Oh, man, I hit my thing again. So EPV. So SQQQ, SDOW. There's also some other pro short funds that short, like say the Russell 2000 or the S&P 500. You could look at any of those. Gold and silver stocks looking good. So the pro shares have some that if gold and silver go up, they go up double. So you have Ultra Gold, GL. So UGL, Ultra Gold is for the gold. AGQ is for the silver. So if silver goes up 5%, it'll go up 10. If silver goes up 20%, this will go up 40. Same thing, this kind of doubles the silver market, it doubles the gold market, UGL. So if gold goes up 20%, it should go up 40%. Those look really good right now. And then of course you have like the miners, AG, SILV, SVM, MAG Silver, EXK, GOLD, Royal Gold, Sandstrom Gold. Yeah, those all look good. GDX is just more of an index, so kind of it's more of a basket approach. So it's going to have like a bunch of this kind of stuff in more of an index, and you could just have like one and have a basket. So hope that gives you some good ideas of what's going on in the economy right now and how to allocate your 401k. And again, go ahead and hit that subscribe button so you can get notices whenever I put out new videos, and you have an awesome week.